Control. This is Pumpin' Powell of Fed Air. We're not coming in for a soft landing. We're coming in for a perfect landing. Today, we'll discuss whether to chase or not to chase. That is the question. Believe it or not, we got a bunch of earnings to discuss. We still got some retailers. Kroger's having some good number. I do have an update on the Kroger's coleslaw. And we'll just talk about the market. We got some numbers at 8:30 that might shake things up. Jeff Hirsch, Stock Traders Almanac. He might have to rewrite that thing for next year. Well, what's that get you? It gets you pre-market prep. Mitch, let's get us going.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right. Good morning, traders and investors. We're up 5 3/4 handles at 40.87. We got a number on the upside. That number on the upside, the closing price before we had the big puke in September was 41.37. So we will look at that as a level on the upside today because there's really not much else. We do have Bitcoin that's trading in the red by $40. We have crude that's up 92 cents, 95 cents at 81.50. We have gold up 39.60, 17.99 and a half. Silver that's up 67 cents at 22.45. The buck is down 58 cents, 105.32. TLT having a good day, up a $1.54. And somehow I got out of order on these things. But let's bring in Triple D and let's bring in Money Mitch. And the question for you, Triple D, is this enough to get you back? Are they going to get you back? We got to get a dip here. We got to chase or not to chase. That is the question. The whole year, the thing has been not to chase.
Yeah.
And we haven't given anything back today.
No, but I think it's still not to chase. I mean, we already saw a big move here before on the CPI, and they gave you another shot. It's the market that continues to give you shots, so I don't think you need to chase here. I do think we got room to 420. Okay. We knew it set up well for seasonality. The market wanted an excuse to buy stocks. Stocks had pulled back significantly from where they were. I mean, look at Square. It had the big move from 50. Everybody's chasing up at 75. It pulled back and consolidated in the 62 range. I mean, a lot of these stocks have just consolidated here. So they actually were primed to go. And Powell gave them some gas. I mean, it was a coin flip event, really. You know, was he going to be hawkish or was he going to be dovish? He was a little bit on the dovish side. And that was good enough for the markets, and they never looked back. So this market's being driven by Fed policy, Fed speak, and that's pretty much it. So that's pretty much what matters. And he kind of hinted, Mitch, maybe you can give some of the comments for people who didn't see it yesterday. Yep. But he kind of hinted that there was going to be a slowdown in the increase in rates. And well, he didn't hint, he said it. So people are interpreting that as a pivot. I don't think it's a pivot, but I do think that, you know, I would have thought 50 was a possibility already. Well, it sounds like it's not just a possibility. It sounds like 75 is completely off the table.
Well, don't worry, because Sergeant Pepper Lonely Heart Club Band is here for you. Let's go. I'm ready. I'm ready to lead us through this market. Money Mitch here. It's December. Let's go.
I don't even know if you're going to get fined for this music here because I've never heard that music.
Let's go. Let's get into this market.
Wait. You've heard that song before.
I don't think so.
Oh, come on.
I don't think I know that song.
Dennis.
Oh, my God.
I don't think I know that song. I don't know if they play that music in Canada.
Yeah, they're not allowed to play it in Canada, I think.
Have you ever heard of the Beatles?
Oh, is that a Beatles song?
Who's never heard of the Beatles?
That was a Beatles song?
Who knows that?
Yes.
It wasn't one of their main songs.
Sergeant Pepper's Lonely Hearts.
There was a whole movie.
Band.
There was a whole movie.
I don't
Oh,
know that one.
man, I can't believe it. You're so young, Triple D.
I know Mitch
Oh,
is
my
young
Lord.
too. Yeah.
Gosh. Hit the like button for that because, yeah, like you guys said, I need to make some of those Beatles bucks back, like Thinking About It says. So hit the like button. Get it started today. Let's get right towards the action. Going to lead us through. There's a lot to go through, so let's go.
I listen to gangster rap.
Oh, yeah.
I'm a little bit different.
Can I take a little break here? I need a little break. I need.
We listen to NWA. We listen to Eminem.
All right, I'm leading us through. Let's go.
Yeah, Dennis. I could just see you with the jeans and like your butt hanging out and like the chains. Is that the way? Is that the way you walk around your high school?
He wasn't cool enough for the Beatles, you know. He was more of that hard rocker
cigarettes. He smoked cigarettes
80s
out at the smoking lounge.
He was wearing leather. He was a leather wearer. I'm sure he was wearing some good leather back in the day.
Did you have nunchucks?
Let's get towards it. Let's get towards Jerome Powell here. Give you guys the comments that he gave. I'm going to read some quotes. You guys take it how you guys want to take it. And, of course, you guys see how the market took it. And I think that's what matters most. But let's get towards it. Federal Reserve Chair Jerome Powell appeared to confirm a slowdown with the central bank's tightening. Right now, let's get towards these comments here. These are specific quotes pulled out. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time moderating the pace of rate increases may come as soon as the December meeting. Despite some promising developments, we have a long way to go in restoring price stability. Given our progress in tightening policy, the timing of moderation is far less significant than the question of how much further will we need to raise rates to control inflation, and the length of time it will be necessary to hold the policy at that restrictive level. It's likely that restoring price stability would require holding policy at a restrictive level for some time, as history cautions strongly against prematurely loosening policy.
There's a lot to take in there, but basically, in summary, he's a little more dovish than he was yesterday. And the market
is he really though?
I think so, but I would have expected a little bit of that speak. You know, because we did get this late CPI number. I don't think he said anything that I didn't expect, but the market, we know this market price is in nothing. You know, the most inefficient market hypothesis is what we're trading in right now. And they're like, oh my goodness, he's not going 75. Well, I didn't think he was going 75. I thought he was going 50, but the market obviously thought he was for sure going 75 because when the hints of 50 or less came out, they bought stocks and they could not stop buying stocks. Valuations, who cares? It's a bull market. Back to all-time highs. That's what the market thinks. I disagree, but it's still, you know, it's hard to argue. We've talked about this 420 possibilities. That's not even looking like a possibility. It's looking more like a probability.
You know what I think really caught people off guard too is that there was no shake and bake. You know, usually like with his comments, you know, that there's a pop, there's a drop, but it was in Mitch, I commend him. We don't talk about 1 minute charts very much, but it was like 1:30. We're at let me get my handles right. 39.50. And it was like a minute into the speech. Yeah. And it was like, whoa.
He didn't even give any, he didn't breathe into the mic and it was already ripping.
Yeah. It was ripping. And there was nothing.
And it wasn't looking back either.
It wasn't what he said. That's what I wanted to state at the close. It wasn't what he said. The market was going up regardless of if he would have even mentioned some hawkish tone. I think the markets would have gone up.
They wanted an excuse to buy stocks. We had pulled back pretty substantially on a lot of growthy names. I mean, ARKK was kissing near its 52-week low. So we got to give it a little bit of perspective. This rip-roaring kick-butt rally here, the growthy names kind of got back to where they were last week. I mean, yes, the S&P is making new highs, but we know value has been driving that bus. Does the value train continue here? It was continuing yesterday. I mean, the banks were down in the morning, to your point, Mitch, and then they brought them right back up here again. So I do think that's value names you're buying on dips. I think those are the names I'm looking at. But, you know, when we're going into a risk-on market, obviously you're going to get bigger moves and the Teslas are going to get bigger moves than some of the other names. There's room. These stocks are oversold, so there is room to the upside. I just find trouble to like just get rah bullish. Like this is it. We're going to new all-time highs. I mean, because at a certain point, Chad doesn't want to talk about that. The Dow, Joel, we're talking about the Dow, which is very diversified, not like the NASDAQ, all tech stocks. S&P's diversified too, but the Dow's loaded up with a bunch of different stocks, but more value type stocks. So diversified in the value type sectors. I mean, 369, 346, we're off what from the all-time high? 6-7%? Is that right?
Right
Am
there.
I getting my math right?
Nothing.
We're within striking distance on the Dow, like striking distance by the end of the year, which is insane to think about. That's why I have trouble coming in here and buying stocks because, like we've said on this show, they're not cheap. They're not cheap. So if you're buying stocks here, you're basically saying it's a foregone conclusion. He's navigated a soft landing. This is over. It's party as usual. I don't think I'm that bullish. So I'm not chasing stocks here. I will be buying dips. I will be selling rips, but I can't come in here just with two hands and say, yep, this is it. New all-time highs on the Dow. Because if you're buying stocks here, that's what you're saying.
Now, one thing, of course,
I came up with 6.3%.
We're only 6.3% from all-time highs on the Dow. Nobody likes to hear that because everybody is loaded up with tech stocks, which NASDAQ down 27%. We know many individual names in the Cathy's fund are down 50, 60, 70, 80%. It feels like this horrible market that we've been in, but it's just not the case. This market has not been that bad. It's been bad for tech stocks. It's been bad for growth stocks. Value stocks, we've talked about Deere. It's right there, new all-time highs. We've talked about Caterpillar. It's the tale of two markets. So when you're just analyzing that, I mean, I still want to be in those value type names on pullbacks, but this is not just like, oh, everything's been so killed, we've got to bounce back. We haven't really been killed that bad. It's only been pockets of death, and that's the stuff that never should have been up there in the first place. So I still think you got to be somewhat cautious because some of the pain could still be ahead of us in the new year. And everybody is silent.
No, that was my fault. I was on mute there.
Okay.
I was talking to myself. All right. So
I
one of
talk
the
to
things,
myself all the time.
Of course. So now we get, of course, Jerome Powell starting to think that he's going to slow down the pace rate. But remember what he said in the first quote, and I'll go back to it to kind of point towards it. He said that it may come as soon as the December meeting. He gave no guarantees.
Yeah.
And so I want to go ahead and keep that in mind. And
he's waiting for the next CPI number.
And one of the things that keeps me a little bit more tamed is that, yeah, we've gotten this nice push up. But one thing that he clearly is saying that we might need to stay at restrictive levels for some time. And if we stay up at the Fed fund rate, interest rates at like, let's say 5 or 6, who knows, Bullard's 7%, and we stay there for the whole year next year, what's going to happen to the markets?
We cannot stay up here for a prolonged period of time. Could they handle higher rates for a year? Maybe. If we have to stay up here for multiple years, where we're now looking at the new norm of having 4, 5, 6% interest rates, your mortgage in some cases, if you're not, a prime, you could be borrowing up to 6 or 7%. If they have to go to that, it will eventually hit the markets. It has to. So because people are too levered. Like we said, in the short run, people can handle it. They had a lot of savings. They have a lot of equity in their homes. They've had a lot of free money that they've been sitting on. Those savings are now gone. We've seen the charts. Those are exhausted. And credit card debt is starting to go up. So it takes time for the economy to start getting hit. It takes time for the Fed's plan to work. I think the Fed's doing the right thing. Slow down, slow the moderation, and just let our higher interest rates slowly do their work, because that's what it does. It does it slowly. People don't just stop buying stuff because they don't look far enough ahead. So they're not looking, oh man, I'm going to be in trouble next year. They're like, no, interest rates will come down next year. We'll be okay, and we're okay to get there. So you got to break that mentality and say, oh my goodness, interest rates might be up here for a while. And then people will stop spending as much, and then prices will start to come in. But everything matters. The only thing that matters now is the CPI report in December. And if that comes in for whatever reason, even slightly hot, they're going to be like, oh my gosh, it was a one-off and it'll be a disaster for the markets. If it comes in light again, green light buy, they'll be like, we've beaten inflation, and they will take that down to new all-time highs or be close to it. So I think it's all dependent on what you think that next CPI number is going to be. I don't know. I'm torn. Tough market to call.
I think, yeah, I did listen to his speech a little bit, and what I thought was interesting is that the way that he put it with like the economy and the jobs market, and we just have to go back to this. I mean, we just went through such an unusual period with with the pandemic, right? And supply chains and business stoppages and everything, and that was a point that maybe they would have started before that. Maybe rates would have, the interest rate cycle would have changed. And I just like the way he talked about that with, a lot of people retired, from it. So that opened up the job market, right? And these retirees, they're like, huh, after that, I'm done. I got my money. I'm gonna be conservative with my investments, and I'm gonna spend it. So that's kept the job market buoyant. So I think what he was saying more than like we got inflation licked. What I got away from the speech was like, we've really ratcheted up interest rates, right? But the economy's hanging in there. And I that's what, I think that's
And that's the
more what I
truth.
got out of the speech. The other thing, just, yeah, yep.
That's the
Working
truth.
through that excess, chips,
Yeah.
supply chains, all this
Yeah.
stuff. I mean, yeah. So that's why. And then I'm just going back to the indexes, Dennis, I know we've been S&P centric for a long time, but I mean, it's just too tech heavy.
Yeah, it's that tech
The
heavy.
apples, yeah. I mean,
And the Dow is not.
Yep.
And that's why the
Yep.
Dow, when you look at it, you're like, wow, I wish I was invested in the Dow. But you know what? In the last 10 years, you've been in the Dow, you've been in the NASDAQ, you've been a lot happier in the NASDAQ, I'll tell you that. So it's just
Right.
giving back some of that outperformance.
Yeah.
I mean, does again, it comes back to valuation. This market has moved into valuation, and that's why you continue to see the relentless bid and the low PE stuff, and you continue to see the overhead supply and the high PE stuff. It's like they can't get traction. They rally for a day or two, and then there's more sellers that come in. So, I mean, this market is obvious what's happening. It's PE expansion and the stuff that honestly was just trading and forgotten. Like the drug stocks, I think you still got to buy them on pullbacks because we're still in this market where PEs matter. Merck is all-time highs. Gilead, full disclosure, own Merck. Gilead is new highs on the move. It's far off from all-time highs, but new highs on the move. I mean, Amgen, go to that one. Right there, up near all-time highs. You've got, Lilly, which obviously all-time Alzheimer's drug and stuff that's happening. It's at all-time highs. Biogen ways off, but it's been moving back too. I mean, this is the tale of two markets. And there is a bull market. There has been a bull market going on for the last 2 months in the Dow stocks. There's been a bull market going on in the drug stocks. There's been a bull market all year in the energy stocks. And there's been a relentless bear market in tech. And that's the biggest problem is CNBC and everybody is focused on tech so much that everybody has, the blinders on that we are in just the worst market ever. This is hardly that, folks. It's been a bad market for tech, not a bad market for everything else. So I don't even think the recession has come yet. I think the recession will come if interest rates stay up here for a prolonged period of time. So it's still going to matter what's going to happen going forward. 50 is good that they're only going to go 50, but they're still going up. There's no pivot here yet. There's no indication that we can bring the rates back down. And if rates stay up here, like to your point, Mitch, for the next year, eventually the economy starts to get hit.
All right, let's go now towards the earnings stock. Let's talk about Salesforce.com. Q3 EPS at $1.40 beats the $1.21 estimate. Sales at $7.84 billion beat the $7.82 billion estimate. Salesforce sees Q4 22 adjusted EPS at $1.35 to $1.37 versus the $1.34 estimate, and also sees their full year 23 adjusted EPS higher than their estimate. Now, the surprise was Salesforce Vice Chair, CEO Brett Taylor stepping down.
And that's what really hit the stock. And obviously we had Benioff on Mad Money last night. He was sad to see him go. They know it's a big loss for them. Stock is getting hit. I do think, I tweeted this last night, I do think after the move from yesterday in the S&P that money managers will be coming in here today and saying, what can I buy? I think that they do come into a stock like this for the simple reason is that there's people who missed it yesterday. And they're like, okay, boom, I'm getting Salesforce lower than it was yesterday. Okay, they did lose, key executive here, but at the same time, stocks are hot right now again. So I think buy the dip mentality will be back. I do think this dip gets bought in Salesforce.
Is the PE too high on Salesforce?
A little bit, but I right now we're in risk on mode, Mitch. They were buying stocks there. So I would say until the next CPI data, I don't know if I want to hold it. Because I don't know what the next CPI data is, but you got 2 weeks before that. Yeah. I think if I'm just that money manager and thinking I got too much cash in my hands, and I'm that too, thinking, okay, well, what can I buy? You look at the 2 or 3 stocks that are getting beat up here today, and you think maybe I'll jump in those. So I think Salesforce could get bought here today.
I'll just do quick technicals on this one. I don't know if it's quite the CrowdStrike setup from yesterday, but you do have a buyer in the lower 147 handle. They've stepped up to 148. Nothing really on the dailies to confirm that. You're right here in this area. So then if you're looking for more on the downside, if you get fills there, look at the 143 area. And I just want to bring it talk. The pre-market action. Of course, the market had a lot to do with this, but there was someone in there at 109.30, 110 in the pre-market. This is the hourly pre-market chart. We talked about that. I mean, they were there. They weren't paying 115. They were paying 109, 109 and a half, 110. Came down in the regular session and just faked everybody out. You got through that level. I think he got to 10, turned around, 108.89. So still got through that area, but not by much. Then you got above that 115, which was keeping a lid on the morning. And then you had one of the greatest rallies of all time that happened. So look for a similar setup in CRM today.
All right, let's go to Snowflake here. Snowflake EPS at 11 cents, beat the 4-cent estimate. Sales at 557 million, beat the 539.1 million estimate. I feel this one would fall under that maybe growth that could get the lift today. What do you see?
It already did. They came in and bought the dip on this thing. It was down $20 almost at one point in time. Hit the 123 handle, 19 points it was down. And they came in and they bought the dip on this one already. So if we just, go and, summarize really the earnings from last night, the majority of them actually kind of rallied here. I'm just looking through them like, you got the Oktas and the Splunks that went up. And the ones that dipped were CRM, the main ones, and Snow. And Snow, they've already bought the dip on. Now, you can say, Dollar General is a good dip to buy on, but you got to be careful. It's risk on market. So Dollar General is defensive. Dollar General is up near all-time highs, different type of stocks. Just bringing it back to Snowflake, though. It fits the script that money managers are looking to buy stuff. Snowflake down 20 on a day that the market ripped up, 120 S&P handles from the low. They come in and they buy that stock, and they did.
All right, let's keep going. Do you want to give?
And again, people will say, "Oh, you're buying."
Yesterday, 132.
People want to hear what they want to hear, and just because I'm saying that's what the money managers did, it doesn't necessarily mean what I'm doing. It doesn't necessarily mean, I'm buying Snowflake in my long-term account at 20 times revenue. I'm trying to tell you from a day trading perspective, when the market moves up like it did, you get those dips on those days, they're more prone to get bought. Yeah. If we're on a really bad day, markets are tanking, we're down 100 S&P points, those dips are not getting bought. So the dips are probably getting bought not because of Snowflake, that they see something. It's just because money managers are scrambling to buy stocks.
I agree. So at the end of the day, just keep it simple, right? If you were a money manager and for some reason we're on the sideline on this run and you saw that run yesterday, what would you be thinking today? Just ask yourself what can I buy? Question. Exactly.
You're thinking, what can I buy?
Let's go to Ulta.
I'm not saying I'm bullish Snowflake and I'm like, this is it. We're going to go rah all in.
Let's go to Okta here.
What the money managers are likely to do. Meaning, definitely. I would not be selling Salesforce down 11 points here right now because I think there's money managers looking, what can I buy? So my job as a trader is to anticipate short-term demand. It's how I make my living, by anticipating short-term demand. That's what I try to do for you on this show. I try to anticipate short-term demand. I'm sometimes right. I'm sometimes wrong. I'm sometimes indifferent and not making a call. But that's my job as a trader, is to anticipate short-term demand. And if you're a trader, that's your job as well.
All right, let's go to Okta here. And I would say that that's kind of more behavior finance there that you guys are getting a little insight on, Dennis, there. Let's go EPS here at 0 cents, up from the loss of 7 cents year over year. Sales at 481 million, beat the 465.34 million estimate. They see their full year adjusted EPS at a loss of 27 cents and a loss of 26 cents on the low end, versus the estimate that was a loss of 72 cents. So getting a little bit better there, still not in the positives, but looking good there for their full year 23 adjusted EPS. And then their guidance also above on their sales there. And then also Q4 EPS looking into the positives versus a negative 11 cent estimate at 9 to 10 cents. So good outlook there.
Again, beaten up name, just been destroyed. Give me some silver lining. That's all the market wanted from any of these stocks. And they got it in OAKTA. They're looking at stocks to buy. They're buying at 62. Automatically, people say, I sell the rip and growth stocks. But you're in a different market right now. You're in a market where money managers, we'll bring it right back to this, are looking for stuff to buy probably today because they missed it yesterday. And some people didn't miss it. But, nobody on Twitter missed the rally. They're all fully margined in. But I mean, in reality, we know everybody on Twitter just talks about their winners. They don't talk about their losers. I'm telling you, there's a lot of money managers that missed yesterday's rally. So that doesn't make me so inclined to be shorting rips right now. I'm like, oh my goodness, this is a great opportunity. Let's sell Okta. It's not the kind of day we're in here right now. I'm not saying necessarily to chase, but I'm saying dips are going to get bought. I'm more inclined to buy the dip as opposed to sell the rip just because of the action yesterday. Short-term trading hat on.
All right. We gave any levels there, Joel, for us to watch?
Pre-market high. Yeah, pre-market high is right here at the 62.50 area. I'm just going to give you a potential. Like if we can get through that, you always got to get follow through. 63.32 was a high back in September, and then a pair of highs at 65. So hard for me to give you support on a stock that's up $9, but that's what I'd be looking for on the upside.
Here we go. PCE coming here too, folks. So
3 minutes.
So much. Yep. I'm trying to get through the earnings. Can't get through the earnings.
I
gotta get
wide.
through economic data here.
I'm going wide.
Yeah. Go ahead, man. This one's gonna be some little fireworks here. I'll read you guys some estimates here of what's gonna come out at 8:30. There's multiple reports. There's initial jobless claims. Estimate is 235,000. Prior was 240,000. Right. So we want to see initial jobless claims jumping up. If you're a bull, you want to see that if you're them coming in under, if you're, of course, a bear in this environment. Core PCE is the next one, right? Core PCE estimate 0.3, prior 0.5. PCE month over month is estimated at 0.5, prior 0.3. Then when we look at core PCE year over year, which is estimated at 5, prior was 5.1. So that's actually a good outlook there. That would mean that the core PCE year over year is going down a 0.1. PCE price index year over year is estimated at 6.2. Prior was 6.2. So let's see if we can get that actually under, let's say towards like 6.1. That'd be a good outlook there. What we don't want to see is like a 6.4 or 6.5 there for the PCE year over year number.
So 30 seconds away from that. That could be a game changer here too. It's not going to move
like
the
algo
CPI, but it could move.
They're already jumping
a little bit. It's going to go wide.
Yeah, the
already
algo,
15.
Yeah.
The question is,
91.
Did Powell have these PCE numbers?
There's a good question there too. and actually, a Fed official. Oh, we gotta wait. PCE is coming right now.
Oh, going wide there. Going wide. Looks
getting
like
hit.
it's
getting hit. They don't
right
like
off
it.
the top.
They don't like
Spike
it.
up, spike
They don't
down.
like it. But all right, initial jobless claims 225,000 versus 235,000 expected. That's light there. Look at the wideness right now. 408.79, 407.90. That is wide right now. Continuous claims at 1.6 versus 1.57. So that's at least a good outlook there in the continuous claims. Still looking at some extras numbers coming in here. Looking for the PCE data. Trying to pull that up here for us.
Danger, Will Robinson.
All right, PCE for October 0.3 versus 0.5 expected. That's good there for the PCE month over month. came down there to 0.3 versus 0.5. I'm looking now for the year-over-year numbers. I got core PCE coming in, an important one, 0.2 versus 0.3. That's actually a good outlook. Estimate was 0.3. It came in under that. So core PCE coming down there. That's a good outlook there. Year-over-year number at 5% versus the 5% for core PCE year-over-year. So that's at least not looking too bad. That's just coming in line there. So at least from what I'm seeing here, the only thing that was in the negative was the initial jobless claims. For the bullish side, continuing jobless claims coming in a little bit higher. That's a good outlook there. And then I look at the PCE numbers. Those are looking good here as we're getting the push now towards 409.17.
Wow.
Joel, how you seeing the markets? You there?
That was the fastest dip I've ever seen bought. That dip was spot so fast.
So
yeah, I don't know.
So
Can you guys hear me at all?
Yeah, we can hear you at least. You're good on audio. All right, so SPY definitely jumping up there towards 409 and 40s now.
You gave all that information. Yep. I'm looking, 4130. Big.
The
There's
dip
not
was
much
bought
out there.
so quickly. Joel's audio is going to cut out here again. Here we're going to have to just. I don't know what we're going to do on his audio. We're going to have to figure. He's going to have to get a new audio. Sorry, Comcast. I think you're going to lose him as a customer because it's just not working. We got 2 minutes until our guest.
So
Joel's trying to figure it out in the background. It's been too long. Comcast just can't get it together over there. So
we'll be getting Jeff on in a second here. We can take a look at what came out. This was the only number that was under, I would say, of the readings, right? And then we can look at continuing jobless claims. Continuing jobless claims actually came over the expected there. So that's actually a good outlook here. Crazy.
It's crazy move. So we dipped. We got back to unch on S&P for about a split second. And then that was it. And then they just started buying it, and they couldn't stop buying it here again. So I don't even know what to say.
And that was wide, man.
That was wide. We were a buck wide on SPY. You don't see that very often. We were $1 wide on the SPY there. So even if you had orders out there, you probably could have got picked off. You were sitting there. But if you tried to go in after the fact, you had to be out there. It was the only way you were going to get filled.
Yeah, you had the jump
orders sitting out there ready to go, which takes a lot of guts going into a number to just be sitting out there because you get picked off.
Yeah,
so
almost instantly.
Well, you do instantly. So now they're buying them again. They can't stop buying them. This is the way this market is. Tricky market. Again, obviously tape bombs happening from inflation perspective. Tape bombs happening from Powell speak. It's all macro data right now. It's the only thing that matters. Technicals are pretty, can give us a target to 420. But again, we're just listening. Fed is controlling this market. Inflation data controlling this market. Obviously, economic data. Macro data has never mattered more. It's never mattered more than it does right now.
Hey, it looks like the Q4 rally is still on. We were looking at to see if we would get that Q4 rally. Looks like Jerome jump-started it yesterday. We're getting a nice little push here from some inflation data. And from this moment, we won't get anything until the next Fed meeting. And so at that point, we'll probably maybe get the 50 basis points, and we could even be higher. Who knows? Maybe we can continue going from that. This does leave room now that, we're close to 410. I did draw this upward trend line from kind of the downward action that we ran into it one time in August and prior. Now it looks like we're running right into that. We're actually looking like we're going to maybe break that outlook today. So that's definitely an impressive move. Of course, a lot of people are calling for the 200-day moving average. We've already broken through there, 403.96. So that's kind of maybe pullback level that I would maybe look for 403s, 404s to hold on pullbacks. But if 400 holds now for the end of the year, I think we got to stay, at least for myself, even in the bullish shoes. So I'm going to be looking at that 400 for a long time now to just make sure that we can stay above 400 and maybe follow the trend. This is when I like to trade. I know a lot of times we talk about trading that when it gets difficult is that sideways action. But when we start getting breakouts where we actually get a trend, that's when the trend traders come into play and they're looking to ride that momentum. We'll just have to see.
They're looking to go to 420. The trend guys are saying I'm buying dips and we're going to 420. And I'm not going to argue with that. I don't want to buy the rips, but they've quickly bought, the algos quickly bought that dip here at 830. It was there for a split second and they're all over it here again. Tricky market. So many tape bombs. It's one of the toughest markets I've ever seen to call. We've been saying this for the last 2 months. Sometimes you can get a market that's like, that's a pretty easy call. And then you get these other markets like, wow, I don't think anybody can call this market. The Goldman Sachs executive, said it a month and a half ago. Nobody's calling this market day to day. I mean, and it's true. It's you don't know what the next tape bomb's going to be. We were going through corporate earnings before. Obviously, we're through that. But I mean, unless you know these inflation numbers, unless you know these CPI, unless you know what Powell is thinking, it's tough to just say, yeah, this is what's happening and this is where we're going. There's no outlook here. 5-6 days from now, nobody knows where we're going. So you trade what you have. And right now, the bulls got the momentum. So I'm buying the dip. Tomorrow, I might be selling the rip. But as a day trader, I'm buying dips.
All right, let's go ahead. Let's bring on our guest today. We got Jeff Hirsch in the background. Let's bring him on. Jeff Hirsch, editor-in-chief of the Stock Trader Almanac. Welcome back on, Jeff. How we doing? Looks like we got a little fireworks this morning.
We're doing great. How you guys doing? Great to be with you.
Jeff, it's been a while. How's it going?
Yes.
Yeah, how's it going?
Going great for midterm election year seasonality and the Almanac outlooks.
Well, this is what we need. We need to know. Give us the crystal ball. We know that the Stock Trader's Almanac can sometimes be used as that. So give us that crystal ball here, Jeff. What do you see going into the end of the year?
Well, I mean, it's never crystal clear, the ball, but the trend, the history, the longer the current market tracks the history, the more confident we get. And this year has been a case in point, not necessarily levels, but you can see the trend, some of the charts we've been putting out there all year about the midterm years and, our aggregate cycle chart, which is midterm years, all years, and second years of decades, and analyzed to 62 and 74 and all that kind of stuff. I mean, we're long, we're bullish. We had our seasonal buy signal. You guys are day traders and selling rips and buying dips. We're kind of contrary and seasonal, which is, our game, a little more swing than the day trade. But, we're not expecting the V bottom. People have gotten used to that. Over the years, recent years, we're looking at some chop. We're looking, general uptrend, taking out or at least reclaiming the 200 days, encouraging for the S&P. Dow's already done that. So we're expecting some chop, but climbing that wall of worry, and that's where we're at. We're long. We're bulls.
Definitely, that's something that I've been watching on an area that I've been looking at seasonality, and maybe you can give me a little bit more insight into it turning around. Is maybe solar. How do you feel about the solar names? They've been really strong lately.
My father started looking at solar when Jimmy Carter put panels on the roof of the White House. As a guy who likes, outside stuff and hiking and all that stuff, I want to have renewable energy as much as the next guy, but I can't touch that stuff. I need growing earnings and revenues and valuations, and then we go to the technicals and seasonals when we look at stocks. So I'm rooting for hydrogen. I'm rooting for solar, but I think we got to stick with old school energy, which is what I have a bunch of in our portfolio. We did a stock screen like we do right around. We get our seasonal best 6 months buy signal, and a lot of small mid-cap energy stocks came through there. So I own a few of those. And then we did another screen after earnings season, and we're able to add some additional stocks to it.
Well, what other stocks? So you like energy. What other sectors, and what are you looking at, Jeff?
I'm in biotech. I own the XBI. I got the small caps, IWM. One of the encouraging things that we saw technically, I don't know if you want to put up the Russell or the IWM,
sure.
But that was chart we've shown subscribers and folks is the way it didn't break the June lows like the large cap indices did. Exactly. I mean, that's the picture. I'll use a little highlighted square there just to make it clearer for people when I draw it. But yeah, that was encouraging for us, and especially, thank you, and especially the that time of the year, around the end of September, beginning of October, not notoriously great for small caps versus large caps. So for the small caps to hold that. That was encouraging. I mean, some of the names, Permian Basin I own, WTI, not doing so great right now. That's on the list to keep an eye on. Murphy Oil. There's a few more that are smaller than that. If you guys, people want to check out the latest November basket, I'll throw out a couple names. We put United Healthcare back in there, one of our favorite industries, because of the pharmaceutical industrial complex that continues to drive money into that industry. We got some semiconductors, some smaller stocks, a little more electronics and computer networks, a couple more energy stocks in there, but that's the stuff we put out for subscribers.
Definitely, you guys got to check out the Stock Trader Almanac to get that list, of course. So definitely check that out.
Everyone gets a free almanac with a subscription. So not everyone realizes we put out a lot of market timing, and there's also sector. We use seasonal sector seasonalities, but we also layer technical and fundamental analysis on top of things, and always a look at what's going on. I mean, you guys were mentioning Jerome, very friendly. I don't know you're on a first name basis, but
Right.
It's everyone's expecting him to pull another Jackson Hole, and there he's like, well, I think we can taper it down a little bit. So
it gave investors the green light to come in here. And, you're a big fan of seasonality. And we know what you like, the Santa Claus rally, but that's a ways away here. How does this period from beginning of December up until Christmas, how does this period really look, from a seasonality perspective?
Very great question. First of all, the Santa Claus rally was invented by my father, Jeff Hirsch, in the 1972 Almanac. And that is the last 5 days, trading days of the year, plus the first 2 of the new year. And it's really an indicator, not a tradable rally, though you can trade it. We combine the general year-end seasonality which is something that Larry McMillan, an options strategist, really he does with the small cap. So you take the small cap effect, which really starts in December, the run from just before Thanksgiving, Tuesday before Thanksgiving, through the Santa Claus rally, and you get a nice trade from Tuesday before Thanksgiving to the second trading day of the year. But to your question, here we are, December 1. We put a little blog post out yesterday, which we kind of keep it running with what's coming around a few days in advance or a day in advance on the calendar for traders, for day traders like yourself. And the first day of December leans a little bearish. But when it's positive, and we think the momentum that we got yesterday from Jerome, our new friend, can carry over today, and the average gains about 1% for the S&P. But beginning of December, when tax loss selling starts to kick in, you tend to see weakness or flat sort of period. I don't know if you want to pull up the little chart we have from a couple of days ago on our blog. I mean, if you go to the website, it's a nice chart. Or, I could share it too if you want to do it. Just you see the sort of little chop at the beginning of December.
Yeah, if you'd like, you can just share your screen, Jeff. If you'd like, you can just share a screen and then show us that if you want. Down at the bottom, you'll see a little present button.
Present.
Hit the share screen, select a window or a screen, and you can just show us so that we can get the inside scoop.
We like the inside scoop.
We always like the inside
share
scoop.
Screen express. Oh no, share screen.
I'm definitely a 2-scoop ice cream kind of guy.
Yeah, I'm a 2-steak kind of guy these days.
Oh, I love me some barbecue. If you don't like barbecue, I don't know. I don't know how you live life.
Did that come up? There it is.
Yeah, got you right there, Jeff.
Hey, look at me, technologically advanced. So I don't know if that's big enough, but I guess I could maybe.
There we go. We got it.
So there's one of my pretty little charts. You could just see I don't know, can you see my mouse in there? There you can.
Yeah.
So the mid-month here, and the red line is the Russell 2000. This is where the old, January effect, not to be confused with one of Yale's other inventions, the January barometer. January barometer is as the S&P goes in January, so goes the year. But the January effect, which was originally discovered by a man named Sidney Wachtell back in the 40s. He was an investment banker that small caps outperformed large caps in January. And we found over the past few decades that small cap outperformance really tends to begin in the last half of December, last 2 weeks of December. So you can see the Russell right here going up. So you're saying what goes on from here to Christmas? We got sideways action. You know, a little bit of chop as tax loss selling, takes hold. You know, you get tax loss selling in a couple scenarios. You got a big up market. People need to cover their winnings. And also you got, a lot of losses this year with the stuff that's with the bear market. People want to sort of capitalize on it, and they can roll those over into other tax years. And then you see the pop into Christmas, and then the Santa Claus rally, which goes into, the first couple of days of the new year. And a little trading strategy for y'all is something we call the only free lunch on Wall Street, which is basically taking stocks making new 52-week lows. It used to be December 15th through February 15th that these new lows outperformed the market. It was NYSE back in the old days. And now we pick them on the triple witching Friday of, and I won't say quad witch because I don't think single stock or ETF futures have any.
We're with you on that. We're with you on that. We still say triple witch to me and Joel because we don't like the single stock futures. So we're not even on the quad witch bandwagon ever.
Yeah,
it's always triple witch to us.
Yes, it's a better phrase, I think. But so on that Friday, actually we do it Saturday morning over the weekend. It gives us time to do the sort that we do. We get rid of, and anyone can do this on their own. Only common stocks trading for more than a year. No new issues, no splits, no SPACs, no IPOs, no closed-end funds, no ETFs, nothing but straight up, Class A, or some companies have a Class B that's their main stock, like it was at Google, I think it is. And then we weed those down, make sure there's no fly-by-night Chinese internet stocks or biotechs or something crazy that's really thin. And we take the ones that are down the most. And years like this, where you've got a down market, that strategy tends to work much better. And we put that out to newsletter subscribers, usually over the weekend, so they can get in there Monday morning. And we try to keep a tight window near where that close is, and trailing stops and that sort of thing. And you take any quick gains and get out of there. It's a good trade for traders like yourselves.
Love it. I love that outlook there, especially going into now the January effect. I know a lot of traders are looking for ways to get some returns to the end of the year. So that's not a bad outlook looking into, of course, December, when we'll get that Santa Claus rally. And if it comes down, of course, towards the end of the year, will there be some profit taking, of course. I feel like that with this big move too, there should probably be a lot of kind of portfolio shifting, reshuffling that, cutting out some losers, adding to some winners, especially with this big pop. I think a lot of the money managers are going to try to, make things look a little bit better, right, underneath the hood. Yeah,
they want to pad the statements, the portfolios. A lot of that happens September, October, which creates that vortex of October phobia, which is there's the October 31st deadline you guys probably know about, where for distributions and such, they've got to make transactions. And there's a whole accounting reconciliation that happens at that time. And a lot of portfolio cleaning and restructuring happens in September, which we saw pretty clearly. You can see it on this chart right here. This is my aggregate cycle chart, which I was alluding to earlier. And the other thing, I didn't mention was the sweet spot of the 4-year cycle here. There's a page in the new Almanac I've got out here, the 23. Of course, you see it right handy on my desk, right?
I like the way it looks.
Thank you. Good. And then, I appreciate that. And then on page 34, we do welcome to the sweet spot of the 4-year cycle.
I like that. Let me put you full screen there. Oh, look at that.
There we go. Sneak peek here.
I love handbooks. I make handbooks all the time. I think they're so important.
So you see the Q4 midterm year through Q2 pre-election year is, all right, I'm going to put that down. It's distracting me. It's that sweet spot where you can see, I'm going to have this chart's on my blog. I've posted it out there. It's not secret, but this is that sweet spot. This is the midterm year, the pre-election year, best year to 4-year cycle, the third year. We see gains from the midterm low, which if we've got it already, which I've got some friendly gentleman wagers with colleagues about the low being in, for steak, of course. For the move from the low to the midterm low to pre-election year high is about 48% for the Dow and 68% for NASDAQ. Not saying we're going to get all that. There's a couple of big years in the averages, but anywhere in the what it said in that little bar chart is about 20% for the Dow and S&P and just under 30 for NASDAQ in that sweet spot, the 3/4 midterm Q4 through pre-election Q2. Now, these numbers get a little bit tempered and muted when you have such a bear market like we've had. When we're still down by, was it 16% by Thanksgiving? That was a pretty decent table I put up there. Here it is. Hey, we're flying turkey. So when you got year-to-date, Tuesday before Thanksgiving, you can see still got a positive Santa Claus rally that Tuesday before Thanksgiving. I don't know if you can see that so good.
There we go.
Tuesday before Thanksgiving to Santa Claus rally, pretty decent. But, December, not bad, but, not blowing my doors off there. So that kind of damage that we've had, can still be there. And that's why we think we're gonna get some chop, but, climb that wall of worry higher. I mean, we could retest the lows. Everyone's thinking an 08, scenario where we retest in the spring. I don't sense. I mean, I know I could barely stick around and listen to SBF on CNBC last night.
Oh gosh, this is tough.
Oh, I mean, was he whining?
They even cut him off and went to Kramer. They had it on for a bit, and then they're like, "Okay, we're done with this." And then they went.
Yeah, I mean, I was actually driving home listening on Sirius in the car, and I called my partner and had our little end of day chat instead. I just couldn't take it. It was a bit much, but
it is.
But the point being that blow up is not equivalent to the blow ups in 08. I mean, Lehman, AIG.
Yeah.
I mean, come on.
Not even close.
Not even close. So that's why I'm leaning into the 62-74 analog. I know, as I mentioned, McMillan before, he thinks we're in the 73 mode, but I'm an election cycle guy, so I really sort of ISO on the 4-year cycle and the midterm year, and the fact that it's tracked it so well, especially the first midterm year of a new Democratic president, which was something that was in the 02 Almanac, 22 Almanac, forgive me. And then I've got that kind of a chart, in the Outlook in the 23 Almanac for the pre-election year and another aggregate cycle version, which is all bullish for next year. And if I was going to tell you about our outlook on the dot plot and the Fed. So we look at their summary expectations and also, Atlanta Fed's GDP now is pretty positive, but the dot plot from September shows, 23 getting into the 4.5-5 range, right?
Yeah.
I mean, where are we now? 4. He said
really
we're going to go
close.
down a little bit, 4.5. Maybe we get another one, 5. And then that's it. So we're much nearer the end of the tightening cycle. And the economy seems to have, held up pretty well. And then there's some earning charts. I know our friend Sam Stovall at CFRA, used to be S&P, has put out his policy notes about the earnings outlooks. And then there's a chart. I think it was Justin Treamer. I don't know if I say his name right, from Fidelity, right, where the market bottoms, a couple of quarters before the earnings bottom. So if the forecast is for earnings to bottom in around June, mid 23, then it's conceivable we're at or very near the low, and the market is an anticipating mechanism, a barometer, not a thermometer, as my father used to say. And it's not going to be easy. You got to honor stops, man. The thing that helped us this year, I mean, we were concerned and cautious with the heightened volatility in midterm years, even before the invasion of Ukraine, and that really pushed because the January barometer, our trifecta, was down. The barometer the first 5 days in Santa Claus Rally was up, but the other two were down. And then, in the portfolios, we just honored the stocks, and we ended up getting into, by April, when we had our MACD seasonal sell signal, we were in cash, and we stayed there most of the year until October. So
now it could be that time to put it back into work. We're just going to have to find out. Appreciate you joining us today, Jeff. Would definitely check out the Stock Traders Almanac, and I'm going to throw up here his Twitter if you guys want to follow some of the action that he puts out there. So give him a follow. Appreciate you coming on, Jeff.
Thanks, gents. Have a great day. Happy holidays.
Good one. All right, let's go ahead. Let's take a look into the market. We're starting to wrap up here. It's 8:56. Let's take a look at how the SPY is reacting after, of course, those numbers. We did get up there towards around a high here. I'm going to the 3-minute, a little closer, 409.74. But let's go towards the 15-minute. You guys can see it kind of topping out there. What do you see today?
Yeah, we had a lot of chop off the 830 number. We got the initial hit, and then they bought. Now they're just kind of fading it a little bit here. So we're just fading a bit. I don't think you're going to see this massive sell-off from yesterday. I think money managers still scrambling on the buy side. Wouldn't be surprised if we do have a follow through. I do think dips not only are going to get bought on weaker stocks, but they're going to get bought in the overall market too. So as a day trader, I'm buying the dips here right now. As a long-term investor, I'm not buying anything. People, multiple people will reach out to me. What are you buying? We know how I work. I buy from the long-term portfolio when the market is weak, not when the market is strong. I won't be buying anything today for the long-term portfolio. So will I be selling stuff? We get to 420 on S&P, I will unload more stocks. But 408, I think there's kind of room to 420. It's kind of, if I was in a swing trade here, I would say 420 would be my target for stocks. I think it's a good target. I think we could get there by maybe even by the next CPI data point, depending if we don't have any more tape bombs. But Fed speaking, tape bombs are always out there. So obviously we still have the right to change our opinions as traders. It's okay to be wrong, not okay to stay wrong. So we're allowed to change our opinions. Right now, bulls are in control.
We'll see what happens. It looks like Santa came early this year. Will he continue? That's what we need to question, right? And I think if we get this run early in December, are we going to get the Santa Claus rally? Could get it a little bit early, right? I think this is something to just keep in mind. We'll see what happens today. Definitely Jerome Powell shook up this market. Now it's time to go do the hard part, which is trading, really. I mean, there's one thing that we can talk about the perspectives, but it truly is hard to actually go and execute on a market that's changing up like this. So
it is a tricky market. And again, people think you've got to make good calls. I got to know where the stock's going next week to make money. You don't. Like this year, again, if I go to my performance, long-term investment account didn't do great. I mean, I had a lot of cash. It probably did better than the average bear, but it was down. Swing trading, I hardly did any swing trades. It wasn't an easy year for swing trading. Day trading, really good. The day trading was excellent this year. And that's just because short term, you get these, you get the moves that are more predictable in the short term. It's always easier to predict where the stocks are going short term as opposed to long term. And people, will say the opposite. Well, we know they're going up in the long term. Well, that's true unless you're in Japan, unless you've been in China, unless you're investing in Russia. I mean, there's a lot of areas where long-term investing hasn't been good, but overall, we know our markets have tended to trend upwards. But if we're going to do this show, we're going to do, if we're going to do this show, if we're going to talk to traders, we're going to be traders, we've got to learn some market timing. And I'm just saying, always the day trading is much easier to do market timing in than the long-term investing.
Yeah, I'll be watching that, especially around the 410 level. That's where my kind of upward trend line runs into. That's kind of like where we pulled back right now. I'm sure technical traders are looking at this too. I mean, it looks kind of obvious from this trend line. And I mean, if we can get into, let's say, for some reason, by the end of the year towards here, where are we looking at? That's completely a reversal from the downtrend. Now we actually start getting out of this.
Well, that's an interesting chart, Mitch. I mean, you're looking at a resistance point right here, right now, when you draw that pretty little, could we call it Carter-Worth trend line, because he's very good at connecting those lines. I mean, 1, 2, 3, 4, you're right here, right now. So if you're saying that downtrend's holding, you'd actually be a seller of stocks here right now.
And then another thing to keep in mind, look at the volume that came in. The volume's actually pretty high. we're finally getting a spike again of volume. And so I think that's one thing to also keep in mind is the volume coming into the market now. I mean, it could have been, of course, with that rip yesterday, but there was a lot of volume coming into this market. And that's one thing that I haven't seen in a while. I mean, look back. At one point, we were trading 44 million shares a day in August. Now we're up there. We just did a 172 million day. I think that the increased volume into the breakout shows me that this could have some legs. We're just going to have to wait and see today to see if we can get that next run. All right, I'm going to let Dennis get out of here. Go do what he does best. Get towards this trading.
.com. He thinks he's got his internet hiccups working out there, so he's going to be over there too. If you want to go catch some more of Joel, I'm going to go trade, try to figure out this market. It's a tough one to figure. That
it is. I'll let you out of here, Dennis. And definitely, you guys can keep up with PreMarketPrep.com, PreMarket Prep Plus. Go on over, catch Joel Elconin. Of course, he's going live in about 2 minutes. He's letting you know his internet's good on that side, so hopefully we'll get that fixed. I know Comcast is going out there to Joel today. I will do my absolute best to get that fixed. Even if I have to fly over there and fix it myself, we'll get it fixed, team. Hit the thumbs up. Stick right here on Benzinga. It's going to be a fun day. I also got a Binance interview on stock market movers. Don't want you guys to miss that. Going to dive deep into the crypto game. Hear what Binance thinks on certain aspects, of course, FTX, and Sergeant Pepper's Lonely Heart Club Band. I'm here to lead the show. Let's get going. Let's get going to live trading. Benzinga TV coming up next. Live trading, Benzinga Live, stock market movers, and a Binance interview. Let's get right towards the market action. There's a lot going on. Hit the thumbs up. I hope that you guys enjoyed today's show, and we'll keep it going right here on Benzinga. Definitely happy holiday times for everybody. Wanted to start off the December month in a little bit more of a cheer here. So the Nutcracker's here to lead us. Let's get to it. Hit the thumbs up. I'll see you guys over on live trading. Let's get it going. This is the day. Big day right now. Market's ripping. We've been waiting for this team. Let's get after it. Get out to the future of crypto. I'll see you next week. New York City. Get out there, guys. Use your discount right now. Money Mitch 20.